Why most investors will lose in the next market crash. Are you an investor looking for the next big thing, or are you just starting out? Most investors that look long-term are able to weather the storm, mitigate risks, and smooth out the losses. Day traders have a very high failure rate, as high as 95%. This is mainly due to poor strategy, risk management, lack of education, and emotional decision-making. Long-term investing minimizes risk, and strategies for long-term usually hold strongly to give enough time to appreciate in value. Some stocks are average returns, while some can be above average returns. Knowing and learning on which asset type you choose to park your money into for long-term will determine if you will succeed in this venture for years to come. Now, the reality is that the next market crash is not a matter of if, but rather a matter of when. And when it happens, most investors, the everyday people, the ones who just started investing, the ones who think they're doing everything right, will lose everything they've built. Not because the market is evil, not because the system is broken, but because they never learned how the wealthy play this game. Please note, I am not a financial advisor. Any information on here is purely for educational and entertainment purposes only. Always do your own research and due diligence before investing your money and consult a financial advisor for financial advice. In this video, I'll explain exactly why most investors lose during market crashes, how the rich use crashes to get richer, and what you can do to make sure you're on the winning side when the next crash hits. As of today, at the time of making this video, the markets are quite volatile and commodities are at an all-time high. Yet we have not yet seen a crash like we have seen back in 2000. It was the dot-com bubble, where the rollout of the internet, many investors around the world began to invest into internet-based stocks, and stock valuations resulted in skyrocketing unsustainably due to investor excitement. When the bubble burst in March of 2000, it led to a widespread market crash. Then there was the 2008 global financial crisis and constrained property market crash. Lenders were too easy in lending money to nearly everyone, which led to people purchasing property even though they could not afford and resulted in all-time high defaults and property price decline. Then we had the 2020 COVID-19 pandemic market crash. We all know what happened here. Every time these occur, there is always a trend many investors fall into. That is due to fear and decline of share prices. They follow suit and don't stay the course. They end up selling their assets at a lower price. A lot of this is emotionally driven decisions and being fearful of lost capital. There are feeling of overconfidence, greed, and people emotions. They say to themselves, this time it's different and the market will never recover, therefore I must sell them and cut my losses. But it's never different, and the market always runs in cycles, and those that forget this concept will pay a high price. Why most investors lose? There are three primary reasons why investors don't get ahead of the game. Don't fall for this trap and always plan well. 1. Emotional investing. You may not realize it, but many of us inadvertently invest with some degree of emotion. As much as we would like to invest logically and filter out emotion, the reality is we are human, and emotions will always be a part of it. The idea is acknowledging this fact and attempt to look at it in an angle of logic and reason, but with a hint of emotion. The trick is, do not let emotions to dictate or direct or control your decision-making when building up your wealth. The moment you do this is when you will stumble upon obstacles and it is harder to overcome. When prices fall, fear takes over. They panic sell their assets, leading to losses and selling at the bottom. When the market recovers, the rebound, and regret kicks in. 2. Lack of liquidity. Most people are over-leveraged, increasing their risk as they find it hard or cannot service it. They invest every dollar, borrow more debt, and have no cash reserves or emergency funds. When a market crash occurs or they lose their job or working income, they are forced to sell their assets at a loss just to survive. 3. No long-term plan. This is very risky if you don't think of long-term. If you only think for today and not for tomorrow, then you are increasing your risk of failure. The average investor buys assets when it feels good, then sells it when it feels bad. This is the opposite of highly successful investors do. A market crash doesn't destroy wealth, but it transfers it. From the impatient investor to the patient investor. From the emotional investor to the logical strategic investor. From the short-term plan investor to the long-term plan investor, and so on. But you get the point, I hope. How the wealthy think differently. The wealthy see crashes as a buy opportunity. They think of it as you are buying assets at a discount. While everyone panic sells their assets, the wealthy take the opportunity to buy these from the panic sellers. They prepare and always have capital ready to be deployed. They know which assets to purchase and what price to enter at. They don't think in days, weeks, or months. They think strategically for many years to come. When the average investor says, "The market is down 30%, I lost it all," the wealthy says, "The market is down 30%. Everything is at a discount, it's time to go shopping." It is the same event, just the mindsets are different between the average and the seasoned. This is the reason the wealthy become wealthier during a market crash. They don't react emotionally. They act strategically and logically. The transfer of wealth. Like I mentioned before, every crash is a wealth transfer event. This is how the rich and wealthy become even wealthier. They know how to play the game. In 2020 pandemic crash, the already wealthy investors became even wealthier as they capitalized on these opportunities in front of them. The 2008 property market crash led to property investors taking over foreclosed properties and enabled them to build a property empire. When prices fall, assets don't disappear. Instead, they just change hands to a more capable investor that knows how to play and control the game in their favor. While majority of investors lose faith and sentiment, they end up selling their positions, selling at a lower end or even worse at a loss. The prepared and strategic investor will quietly accumulate wealth. How you can prepare for the next market crash. What are the best approach to ensure you do not end up like an average investor losing money? Ensure you have cash reserves or capital ready to be deployed at a moment's notice. Think of them like an army, and every dollar you got reserved are your soldiers. They will work hard for you once deployed into an asset. It is powerful to always have liquidity, as crashes will reward those with cash on hand. Diversify your portfolio. Don't have all your capital in one specific industry, and ensure you diversify into other industries and markets. Don't just buy shares or ETFs, but also buy property and business. Never, ever panic sell. This is the biggest risk to a diminishing net worth. If you panic sell, then you have let emotion drive your decision-making, resulting in investor failure. If you hold quality assets, it is best to hold, and when its prices are down, then you must be prepared to buy more. The market will always recover. Always continuously educate yourself. Learn from past mistakes and improve your financial literacy. The people that lose in this game are the unprepared, uneducated, and thinking they know it all. They lose because they never truly understand the types of assets they hold and what their strategy is for long term. You need to adopt a millionaire mindset. When the market crashes, two types of people emerge from the darkness. Those that think and say, "I can't believe I lost it all," and those who say, "This is the best opportunity to buy quality assets at a discount." Same world, same event, same circumstances, but vastly different mindsets. The millionaire mindset knows to be patient, to be ready, to be well-educated and strategic, and think long-term. They know wealth is not built in a bull market, but rather built during a bear market where everyone is fearful to act. Warren Buffett's famous words are, "To be fearful when others are greedy, but to be greedy when others are fearful." This is essentially saying to buy when everyone is panic selling and selling when everyone is panic buying. When the next market crash happens, you need to ask yourself these questions. Do I want to be an average investor that panic sells my quality assets at a low price? Or do I want to be a strategic long-term investor that holds and buys more at a crash? This will set yourself apart from the average and to be exceptional in building wealth. Don't be the majority that lose it all at a market crash, but instead be true to yourself and resilient in these situations so you can weather the storm and persevere. Believe me, the upside will be enormous, and you will build great wealth for yourself and your family. So, what's your next step? Let me know in the comments. Don't forget to like this video, subscribe for more content like this, and share it with someone who's ready to level up their financial game.